You may have heard someone say, "Why would you ever want to borrow your own money out of a life insurance policy?"
You are listening to Wealth Talks with Dr. Tom and John McPhee. Why would you borrow money from a life insurance policy? There are several reasons when you would want to do this. In fact, it makes a lot of sense in many different cases. We're going to talk about some of those today, so you're very clear on when it does make sense to take a policy loan against a life insurance policy. And there are some cases when it doesn't as well, and we'll talk about some of those as well.
Yeah, a lot of people believe that they're borrowing their money when they borrow from a life insurance policy, and it depends on what kind of life insurance policy you have. Because if you borrow from a universal life policy, you may very well be borrowing your own money. It'd be very similar to borrowing money from a 401k or an IRA, except that there wouldn't be a time limit on the repayment schedule. But the interest rate is usually set for you, and you have to pay that back, and that interest goes back into your account because, hey, it was your money that you borrowed. And then they don't want to see, the insurance company doesn't want to see your policy deteriorate simply because you're not paying the interest.
Interesting. Now, in the case of universal life insurance and compared to whole life insurance, when you take a policy loan, the money might come from the same general account, depending on the way that the insurance company manages those loans. So what makes the difference between it being your money in actuality versus your money continuing to work in the policy and being able to access the same amount of money from the general fund of the insurance company?
Well, in a participating whole life insurance policy, people have equity in the policy. And so you set your equity up as collateral, which your equity has to be a certain type of death benefit called paid up insurance. And that then is held by the insurance company as collateral for the loan that they give you out of the general fund. Okay. And so your account really isn't changed or altered unless you were to die while that policy was had a loan against it.
Okay.
And so the policy then can grow as if it didn't have a loan against it because it really hasn't been affected by this collateral usage.
Sure. So when the insurance company makes a loan on a participating whole life insurance policy, if your money is still working, where does the insurance company get the money to lend to you?
Well, the interest that you pay goes back to the insurance company and makes them a profit. So you, in essence, become part of their portfolio. And because they're lending you money that normally would be paid for death claims or held in reserve for death benefit claims, it's like they're paying you your death benefit prior to and charging you interest on it.
Interesting. So that's an investment that they would not have normally made because that's money that would have been in reserves otherwise.
That's correct, because they would have been holding that money in reserve and unable to invest that or make any money on it at all.
Wow. Okay. So how does that differ from a loan against a universal life insurance policy?
Well, a universal life policy, typically you're borrowing money out of your accumulated cash value account, which is an account that you pay extra premiums in, hoping that there will be a difference between what the cost of insurance and the expenses and fees of the insurance company are charging you for the policy, to have money left over in that accumulated account so it can bear some type of return. Mm-hmm. And the hope in that is that the return that it earns will outpace the increasing cost of the term insurance that the universal life policy is based on. Now, there's some problems with that. And even the state of New York just recently issued a warning that universal policies, whether they be indexed, variable, or just plain universal, are not something that should be relied on for a long-term life insurance benefit. This first became a problem in 2014. Those of you who are interested can Google this, but there's a track record of the insurance commissioner of the state of New York warning the public that the interest rate that is earned in these universal products will most likely not meet the demand of the increasing cost of term. And that's a problem.
It is a problem.
if you're looking for a permanent death benefit
Yeah.
solution.
And many people saw this coming long before 2014 when the state of New York took action on it. This has been a problem that's been coming down the pipeline. It's good to finally see it getting some publicity, but it's sad for the people that had those products and depended on them. Universal life insurance is not something that you want to depend on. It's like holding a reed with splinters in your hand.
There's just been way too many lawsuits settled on people that thought they were buying something that was going to last them a lifetime, only to find out when they got into their 70s, maybe even early 80s, that the cost of the insurance had increased so much that they couldn't afford to continue to keep the product. And that's just a foul ball being thrown at you at the last moment when you really can't do anything about it.
Yeah. So don't depend on universal life insurance. Moving to the whole life insurance side now, what is the logic that we need to know about when it makes sense to take a policy loan from a whole life policy, when it doesn't, and maybe some of the strategy behind what makes this useful when we do take a policy loan?
Well, first of all, a 5% loan from a life insurance policy may or not be exactly 5%.
Exactly.
So let's talk about that a little bit, because if I go to the bank and I get a loan for 5%, and let's say I borrow $10,000 and I'm going to use that money for 5 years, then I know that loan over 5 years is going to cost me $11,549. I can do the math real easy. What is $10,000 at 5% over 5 years? What are the payments times the payments? Or, that's an easy figure. But what happens when we take a policy loan, John? It's a little bit different.
Yeah, and it depends on how the insurance company quotes their interest. We work with companies who quote their interest in arrears. That's the standard way to quote it. Also, we work with companies that quote their interest in advance. And so some of the insurance companies we work with even quote their interest rate in arrears, but charge it in advance. So how does that work? Basically, what they're doing is they're adjusting the interest rate. So a 5% interest rate quoted in arrears, if you take out a loan of $100 at the beginning of the year, then there would be $5 of interest that is accumulated at the end of the year. That's how that would work on it. If you take a loan for at the beginning of the year for an interest rate that's charged in advance, then they would adjust that 5% rate to a 4.76% rate. It's equivalent to the same amount of interest, because if you take $4.76 of interest, because you're going to be charged $100, $100 loan balance plus $4.76 of interest for that first year. If you take that and accumulate it at 5% over the course of the year, you're going to still end up with $105 outstanding at the end of the year. So that's the way it works here with the insurance company charging it. But if you pay off that loan before the end of the year, then that is a lower dollar amount of interest that you had to pay.
Yes, and so if you're making payments on this $10,000 loan from a policy versus a $10,000 loan from a bank that's charging in the arrears,
Okay.
there's a difference of, my goodness, 50, 30, almost $80 there, isn't there?
Yeah.
So you're going to save an additional $80 by taking a policy loan at 5%, where the interest is charged in advance, versus taking the same loan with the same interest rate from a bank that charges in the arrears. So that has to be taken in consideration when, is it worth it to take a policy loan, or should I go and get a loan someplace else?
Yeah. And it would be like if the bank was charging 4.76%, then that would be equivalent to what the life insurance policy is charging when the life insurance company is charging it in advance like that. If you had a low, now let's say that when you have a loan at 5% from the bank or 4.76% from the insurance company, it makes sense to take the policy loan.
Sure.
But what if the bank loan is at 3.5%? Does it still make sense to take the policy loan?
It does not, because that's less than 4.76.
Okay.
Yeah. And so those are the mathematical gymnastics that we have to do to justify the logic behind borrowing from a life insurance policy.
Yeah.
There's a lot of people that will tell you, oh, you just borrow from the life insurance policy for everything. You finance everything through your life insurance policy. Well, first of all, Nelson Nash in his book, Becoming Your Own Banker, said it would take 20 to 25 years to build a life insurance system of policies to make that even possible. And most people have not been doing the infinite banking concept or financing or funding life insurance that long, even one policy, not a system of policies like Mr. Nash said would be required. So it's not really feasible to think about funding every aspect of your life, but maybe in retirement that would be a possibility.
Sure.
But as we go through life, we have to realize, where is a policy loan going to benefit me by keeping more of the money I make in my own control? And that's what the infinite banking concept and keeping more of your money is all about, is not losing any money. That's Warren Buffett's first principle in creating sustainable wealth, is never lose money. And most people don't realize that, but just like Mr. Nash said, Warren Buffett also said that sustainable wealth is built slowly, dollar after dollar, penny after penny, over a lifetime. It doesn't happen spontaneously. It doesn't happen quickly. And so we have to be careful about trying to manipulate and finesse a policy to try to get more money out of it than it really can provide for us.
Yeah. And there are ways to design policies to maximize the cash value and the growth over time. That's where we specialize. After a certain point, though, and I think we've even talked about this on the podcast show, you can try to maximize a policy by adding a huge term rider as well. Sometimes it makes sense to add a term rider depending on what a client is looking to do. But oftentimes, when you add a huge term rider, there's always going to be a cost for that term rider. So oftentimes the cost of that term rider can outweigh the benefits of packing all that extra money into one single policy.
And the problem with a big term rider is that there are no dividends earned on term insurance. And so if you have a big term rider on for 10, 15 years of the policy, and you're paying, a couple of $1,000s for that term rider, or even more, that is all money that is not earning dividends. And that is one of the reasons that we like participating in whole life insurance policies, is that we earn dividends.
Yeah. And so when you get your policies, oftentimes you can't get enough whole life insurance right at the very beginning to replace all of your life insurance needs. And so that brings up the question, well, do you add that on as a term rider to an existing policy, or do you get a separate term life insurance policy? And what do you say to that question, Dad?
Well, we typically try to keep our term and whole life separate, simply because if I have a term rider on a whole life policy and 3 years down the road I have a windfall of cash flow, like Mr. Nash used to talk about, and I want to buy another life insurance policy, but I've put a huge term rider on my whole life, I might have already used up my human life value with the insurance company, and they could tell me, you can't have any more insurance. You've got this whole life policy with this huge term rider on it. You already have the maximum amount of insurance you can own. If I try to convert that term rider before year 7, then I'm in violation of the IRS 7-pay test. That means that my whole life policy automatically becomes a modified endowment contract.
Okay. And that means that it would be tax different.
That means it would be tax different. Now, if we're really going to follow Nelson Nash's plan, we need a system of whole life policies in order to build a financial system that we can finance everything in our life with. Well, if I've got these term riders that are on for 10 and 15 years, that's going to inhibit me from buying the next whole life policy that I need. And so what we do, we use a money managing account where that money can be velocitized without having to go to premium until it becomes sustainable enough to support a second policy or a third policy or fourth or whatever policy a person is wanting to buy. And
Nice.
That's really important.
Yeah, and it makes sense to try and keep those elements separate. It gives you more flexibility and more options than if you tried to roll it all into one. Then you got to stick with that one option for 10, 15 years, like you said, before you can before you can make changes to it without causing a modified endowment contract.
But while we're talking about interest rates and whatnot, it's really important to realize that Mr. Nash's book, The Infinite Banking Concept, or Becoming Your Own Banker, was all about recovering the interest that you're paying to other people. And he said that 35 cents of every dollar spent was going to pay interest in the United States. And I've never been able to come to a definite reason where that number came from. I haven't been able to document it. But I do know this, that currently in the United States, there's $466.2 billion of credit card debt. That's $7,104 per household. And it's just incredible that the interest rate, the average interest rate, according to thebalance.com, is 21.21%.
That's pretty high.
That's huge. Yeah. And if we, try to figure out what the interest that is being paid on those credit card balances, it just blows your mind. I've seen in one place it's over $133 billion every year that's being paid just on credit card interest by American citizens.
Yeah, 21% interest on $466 billion is a lot of money.
It's a lot of money. So let's say that you make a $5,000 credit card purchase and you're paying, 9.71%. You're not the 21.21%.
Okay.
Well, what is that going to cost you if you allow just to pay the minimum price on that? If you just pay the minimum balance,
minimum payment
on that,
okay,
it's going to extend the interest and principal payments out. And what's going to happen? It's you're going to end up paying 17% more for your purchase, $5,850 instead of $5,000 for it.
Okay.
So even though the interest was 9.71%, you ended up paying 17% more. And this is the things that people don't really think about, and why Nelson Nash always said Americans know the price of everything and the cost of nothing. The cost here is $5,850. The price was $5,000. And the credit card companies are brilliant because they have made it comfortable and affordable for people to pay the minimal fee. People say, oh, I can afford $30 a month.
Mm-hmm.
Oh, I can afford $70 a month. And that's the way the American mentality has happened. What Mr. Nash was trying to do is just, let's set up a reservoir so that instead of saying, well, I can afford $30 to MasterCard, why not borrow that money from our policy and say, well, I can afford to pay myself back $30?
Yeah, why not make those payments back to an entity that you control rather than to a bank that's outside of your control where you'll never see the money again?
Now, $5,850 is really not even the true cost. Because what would have happened if I could have earned, 4% on that $5,000 over the same time period? So I made those payments.
So that's called something else. That's lost opportunity.
That's lost opportunity. Okay. And this is what the policy does. It helps us retain earnings on money that we're able to use someplace else.
Mm-hmm.
So if we took in the 4% that we could have maybe earned in the market someplace else, and we add that to that, well, now we find out that the real cost has been $7,266.
Wow.
So that is the cost that we suffered because we used somebody else's money and paid them the interest instead of using somebody else's money while our money was still growing, and participated in the dividends that came from the interest that we paid.
Mm-hmm. Lost opportunity is a funny thing because really there is no stopping point. Once the opportunity has been lost, you could calculate that however many years out into the future that you wanted. It looks like the figure that you used here, it calculates the lost opportunity at 25 years. But who knows that your lost opportunity is going to stop there at 25 years. We don't know how long you're going to live. We don't know how long that lost opportunity goes. And so, when it comes to lost opportunity, we have to recognize that it's there, But
You can't overcome it all.
no,
There's no way you
because
can.
there's always going to be lost opportunity. Whatever you do, there's always going to be potentially something else. It's the road not taken.
Yes.
That the poet talked about years ago in the famous poem. I can't remember the name of the poet who talked about that, but it's the road not taken.
Yes, that's Robert Frost.
Robert Frost.
The road not
okay.
taken. And, so if we can, at certain times, at certain intervals in our life, though, overcome opportunity costs.
Oh, absolutely. It's a huge factor.
boost in savings real quickly.
Totally.
But there's never going to be a time, because we all have to eat, we all have to be clothed, we all have to do things, and we can't finance everything. Otherwise, we would not be able to afford the interest payments.
Right. If you figure lost opportunity on necessities of living, you could go mad figuring lost opportunity. But it is important to recover it as you can, to be aware that it exists, and to manage it wisely. Because when you do that, you're going to automatically win by default, because other people are not automatically thinking about those things.
That's
They're
correct.
living for today and forgetting about tomorrow until many times it's too late, unfortunately.
So why would you want to borrow from your life insurance policy? Well, it depends on what kind of policy you have. If you have a participating whole life insurance policy, the logic behind leveraging cash value from that life insurance policy makes a lot of sense if you understand how the interest rates are calculated and what the opportunity cost would be if you were to finance this in some other manner, whether it's by paying cash for it or whether it's by using someone else's money. And, for example, recently, it's been about 3 years now, that we bought a new car for Michelle. And Ford Motor Company said, oh, well, we'll give you 0% financing. And I said, no, what's the cash price? And when we figured out what the cash price was versus the finance price, the interest rate came out to about 1.19%. So what should we do? Should we borrow money to buy our car from our life insurance policy and pay 4.76%?
No, I'll take the 1.19.
Or yeah. Now, ideally, if we would take the difference between the 1.19 and the 4.76 and set that aside, it would be very similar to what people are trying to say you borrow everything out of your policy to do.
And it would actually be better, because now you don't have the expense to the insurance company. You have the lower interest expense, but you're still setting aside the same amount of money as if you had taken that 4% loan.
And this is another reason why it doesn't necessarily make sense to dump a whole lot of money into a whole life policy with having to use a term writer just to borrow it back out. Because now we've got the expense that we have to pay to the insurance company.
That's very true.
So there's a lot of math figuring to do when you're looking at the logic behind borrowing a policy. And just remember that the facts don't lie, but some people do when they're discussing the facts. And you have to be aware of how this all works to make sure that this is for you and that this is going to keep more of the money you make instead of just transferring it to a different entity.
That's right. One more thing I'd like to say is don't feel like you have to be able to figure all the math to be able to understand it. Just recognize that there is a different rate for interest in advance compared to interest in arrears. There's an interest rate adjustment when you do that. And recognize that a lower rate of interest is generally better than a higher rate of interest, as long as you consider the time factor that's involved there as well. Timing is another big factor that goes along with this. The math, you can get into the nitty-gritty details if you like dive into the numbers like that, but you don't have to. That's one of the reasons that we're here at Life Benefits. If you have a question about a project that you have coming up, some sort of financing, whether it's personal or business, you can give us a call at 702-660-7000, and we'll be able to help you with that.
Well, John, before we sign off today, if I am going to invest $10,000 that I've borrowed from my life insurance policy, and I'm going to make payments out of my income on an annual basis back to the life insurance policy, so I pay that loan off over, let's say, 5 years. Do I have to make 5% on my investment to break even?
Not completely if you change the timing of everything. If you're making payments regularly to the insurance company, then that means that you're paying the principal off, and you're having less interest accumulate on that loan at the higher interest rate. So even if you earn the slightly lower interest rate, it might still be worth it. You just found a way to make yourself save a little bit more.
Isn't this the same type of philosophy that people say, well, if you make a payment every 2 weeks instead of once a month, you'll pay your house off quicker? Because you're paying the principal down quicker.
Yes.
So the interest rates go down. Not the rates, but the actual interest that you pay. And that's the same thing with a life insurance policy loan. So again, you have to understand the math. That's what we're here at Life Benefits to help you do, to do those computations for you so that you really do keep more of the money you make, so that you can build the sustainable wealth that you need for your lifetime and an estate and legacy for the future.
Yeah. So do take some time to understand what the elements of time and interest play as you're building your wealth and growing your money. These two factors are very important to understand. Like I said, you don't have to understand the math behind each one of them, but you do want to understand how they interact with each other and how they play out as you're trying to grow your wealth. You're listening to Wealth Talks with Dr. Tom and John McPhee, bringing you the facts so you can thrive in life. Have a wonderful week.